Welcome back. I will briefly highlight some practical considerations. So in this part I will talk about tax shields and how to value tax shields. So if you follow the capital structure theories, which you most likely have covered in a corporate finance course, there is no benefit from changing financial leverage in the absence of market frictions. Because we are in market friction territory because of taxation, there is a benefit, a clear benefit of increasing debt, and this is related to interest expenses and to the fact that interest expenses are seen as expenses and hence they are tax deductible. Now, put differently, an interest expense carries a tax shield which can be valued. So now I use a company case, and I worked on this many years ago, the Andersons Incorporated. They do focus on farming products in the US. It's mostly linked to biofuel business. They also operate railways as well, and this is, I would say, quite a stable business, more or less stable profit margins, not high growth. So actually it's quite ideal for this type of financial engineering. So ideally, to benefit from the tax shield provided by debt, you have to have a steady cash flow. Yeah, so if you look at a business that is very, very volatile, their cash flows are not stable, this tax benefit quite often is not really worth it. And the downside, a higher leverage and hence higher risk, usually outweighs the upside. So now in this particular case, the setting is right to consider the benefits of tax shields. So what are the different steps you need to take? So first of all, you have to look at your earnings before interest and taxes, your EBIT over time. Look at how stable it is. If you have a stable development of EBIT, I think there is an argument here to consider increasing the amount of debt in your business. Then, of course, you have to check your interest coverage. And we spoke about this before, so we take the EBIT and we divide by the interest expense. Now, interest coverage tells me whether I'm liquid enough and whether, even after suffering a downturn, I can still maintain my interest payments. Now this is quite critical to avoid any changes in credit rating. Because in the end what you don't want is, you don't want to be downgraded, which would then push up your cost of debt, which would then of course kill any benefit you might obtain from saving taxes. So we need to be very careful to ensure that the new level of debt is sustainable. This is absolutely essential. Yeah, so we have to be very careful about this. And we always have to include some buffers in these arguments. So we should be over cautious just to make sure that there is no downside risk. So that's the principle, and of course after you calculate the tax benefit, you can then derive the new capital structure and you can even calculate a new share price, and I'll show you how to proceed. So first some data. Now looking at financial statements, now this is the interest coverage over the longer period, and you see that for quite some time the interest coverage was somewhere around 4, and usually 4 is a good ratio. It was around here for many years, about 4.3. And then in 2007 you see a big increase in this ratio, which basically means that there is some wiggle room for financial engineering. Yeah, so the idea now is to look for a target interest coverage, which might be somewhere around maybe a 4.3, maybe a little bit higher, and to use that to derive a target level of debt. And then to look at the difference between this target level of debt and your current level of debt, which could then give you the additional debt you could take in order to reduce your interest coverage. And then, of course, you would benefit from a tax shield. Now, of course, you can ask yourself, what do you want to do with the money you get when you take out the loans? Well, there are different options. You could pay out a dividend, for instance. You can go give it straight to the equity holders, or you can use it for buying back shares. Yeah, so in this particular case, the business is quite stable. Growth rates are quite low. So there is no obvious investment need. So you don't really need the money for investment. So it's purely done for the tax benefits. So that's the main driver behind that. It's not operational, it's entirely financial. So what do you do in this particular case? It would be sensible to look at a target interest coverage. And here we select 4.3. Now 4.3 is quite conservative, so there is still a bit of a wiggle room. So usually 4 would be quite a solid ratio. Yeah, but you don't want to be going too close to the edge. And then you look at the pre-tax cost of debt. Yeah, again we do this calculation before we consider taxation. In this case, in 2007, it was based on the 10K report, 5.45%. Now this is quite an acceptable figure in 2007. Nowadays this would be a little bit high. Then we could use our target interest coverage and our current EBIT. Of course, you have to make all the adjustments which we discussed before, to derive the maximum level of interest expense, which is 29 million. And then, of course, you can take this maximum level of interest expense and you divide by your pre-tax cost of debt, which gives you then a maximum level of debt, which is $528 million. Now you can check your current level of debt, which is 181 million, and the maximum level of debt, and this gives you quite a substantial level of debt which you could increase. Yes, you could, in this particular case, increase your debt level by 346 million. Then you might consider a safety net, so you might not really push it that hard. You might say, let's go up only by 250 million or 300 million. We want to have a bit of a wiggle room here. But you see there is a substantial amount of debt you could use to increase artificially your interest expenses. And of course you might now argue, why do you do it? Well, because in the end this interest expense will give me a tax benefit because it's tax deductible and I can actually calculate that particular benefit. So that would be the initial recommendation. And then of course you have to think, what are the implications for cost of capital. Now in this particular case, if you maintain a high level of interest coverage, it seems to be unlikely that your cost of debt will go up. It's unlikely, because ratings should not change. So you have to be very careful here that you don't push it too far, that you then suffer lower credit ratings. So one has to be very careful here. So in terms of how we assess these tax benefits, so what we tend to do is we tend to focus on these benefits explicitly and calculate them separately without putting this into our discounted cash flow model. And there are different approaches to how we could consider this, because in a standard discounted cash flow model, you would assume that your cost of capital doesn't really change. This is usually a valid assumption, except you have major changes to your capital structure. In this case, there might be some alternative methods like the adjusted present value method, which might be better suited in this particular case. So now how can we go through the tax benefits? So first of all, it might be useful to derive the market value of equity. So what I have done here is I take the current share price, which is $43, and the number of shares outstanding, which gives me a market value of $786 million. I can obtain the tax rate again from financial reports at 35%. I know the pre-tax cost of debt at 5.45%. I know the new level of debt and the change in debt, which is the 346 million. So I can calculate here the increase in interest expense as the increase in debt times the pre-tax cost of debt. So I have an additional interest expense of 18.9 million. So that gives me a tax saving, so that's the tax shield of 6.6 million per year. And now comes the argument, because I argue that this new debt level is sustainable in the long term, I can use that information to assume that this tax benefit is going on forever. So actually what I do here is I calculate a perpetuity, dividing by 10%, which is kind of what most advisors would use. Now the 10% in theory is an unlevered cost of equity. So basically it's the cost of equity if a company doesn't have any leverage. It's a hypothetical number. So usually, for whatever reason, people assume it's 10%. I think this is maybe quite a valid assumption. So that gives you a value of your tax benefit of 66 million. So then of course you can calculate the 66 million increase in value, because that would be a long-term value increase compared to the current market value, which gives you an increase of 8.4% of your share price. So that's a significant increase, but it's not that massive. So of course you have to have in mind here to achieve that, I have to really increase my debt level very, very substantially. So that is something to have in mind. So now the interesting thing is, what did actually happen? So when we looked at this business, when we provided recommendations, as always, or quite often I have to say, many clients don't really listen. So they actually increased the level of debt more than we anticipated, by more than 400 million. And this pushed down the interest coverage to only 3, which is way below historical levels. So that was risky. And unfortunately, because of that, a downgrade happened. So this whole strategy really backfired. So this idea of achieving a tax benefit is a solid argument if and only if the new level of debt is sustainable.